The U.S. stock market is closed for the weekend. The following analysis is based on the last market close on Friday, November 14, 2025. Nuburu Inc., ticker symbol BURU, closed the session at $0.2488 per share. This was a decline of just over 1 cent from its open, representing a drop of nearly 4.25% for the day. The stock traded in a tight range, hitting a high of $0.2641 and a low of $0.2414, all on heavy but notably below average volume of 27.57 million shares. Now, looking at that price under 25 cents, the immediate assumption is that this is just another speculative microcap stock. And while that is true, what most traders are missing is the profound, high-risk identity crisis happening within the company right now. The common belief, the expectation, is that Nuburu is a pure play on its foundational technology, high-powered blue lasers. This is what brought the company public via a SPAC. Investors see a 52-week range stretching from 12 cents to nearly $1, and they see a story built on supplying advanced manufacturing tools for electric vehicles, 3D printing, and consumer electronics. The narrative is that its blue laser technology is physically superior for welding reflective materials like copper, a critical process for EV battery production, making it a must-have technology for the future. The high trading volume, averaging over 45 million shares, suggests a massive amount of interest and a belief that something big is just around the corner. The reality, however, is far more complex and significantly more precarious. The original blue laser business, while technologically impressive, has failed to generate sustainable revenue or profit. We have to look at the financial reality. As of its last major filing, the company was in a going concern situation, a formal warning from its auditors that there is substantial doubt about its ability to continue operations for the next year without securing significant new funding. Its cash position was critically low, reported at just over $111,000 as of June 30, 2025, against an accumulated deficit of over $150 million. This is not the balance sheet of a healthy, growing tech company. This is the balance sheet of a company on the edge. The expectation of a simple, high-growth tech story is incorrect. The reality is that Nuburu is undergoing a desperate, full-scale strategic pivot, attempting to graft a new business model onto its old one simply to survive. This is what all the recent news flow has been about. The $12 million public offering completed in September was not expansion capital, it was a lifeline. But it is where that cash is being directed that tells the real story. Nuburu is aggressively pushing into the defense and security sector. This is not an enhancement, it is a transformation. We have seen a rapid string of announcements. The acquisition of Techne, a company involved in defense and security solutions. The acquisition of Orbit, which focuses on operational resilience, and a new joint venture with Maddox Defense to work on drone technologies. This is the new narrative. The company is fundamentally changing its identity, trying to leverage its laser technology as a component within a much larger defense-oriented platform. This pivot is the source of the extreme volatility. Every press release about these acquisitions or the transformation plan is an attempt to convince the market that a $32 million market cap company can successfully enter the multi-billion-dollar defense industry. This strategic shift has also created tension with regulators. In October, the company received a warning letter from the NYSE American Exchange. It was not for its low stock price, but for failing to provide the exchange with advance notice before issuing a material news announcement, specifically the one appointing a dual CEO structure to manage this complex new strategy. While the company regained compliance shortly after, it paints a picture of a management team moving so fast to reinvent itself that it's tripping over basic compliance procedures. This brings us to the intense battleground this stock has become, specifically regarding short sellers. The short interest in BURU is very high, last reported at 15.92% of the free float. That translates to 17.28 million shares being held short as of the end of October. The short thesis is straightforward and, frankly, compelling. Shorts are not betting against blue laser technology. They are betting against the balance sheet. They see the going concern warning, the negative $37 million in earnings, the paltry $9,300 in revenue, and the massive shareholder dilution from the $12 million offering. They're betting that these acquisitions will fail to generate revenue fast enough to offset the cash burn, forcing the company into more toxic financing, a reverse stock split, and eventual failure. The days-to-cover ratio is extremely low, at 0.50, meaning given the high average volume, shorts can cover their positions very quickly, which dampens the potential for a sustained, fundamentals-driven short squeeze. What is your take on the rising short interest? Is it smart money identifying a company in financial distress, or is it an attempt to suppress a turnaround story? Let us know your thoughts in the comments. For investors, it is crucial to understand what signals to watch. The borrow fee rate, which is the fee short sellers must pay to borrow shares, was recently 6.66%. While not extreme, it is elevated and has been as high as 12.7% recently, showing that demand to short the stock is persistent. But the most alarming piece of data for this stock is found in the failure to deliver, or FTD, records. In early October, BURU experienced an astronomical FTD spike. On October 6, 2025, over 35 million shares failed to be delivered. The next day, 25 million shares failed to deliver. These are staggering numbers for this stock. FTDs can occur for clerical reasons, but spikes of this magnitude often suggest significant settlement failures in the trading of the stock, a potential sign of extreme market stress, or, as some retail traders on platforms like Reddit have suggested, a possible indicator of naked short selling, though that is impossible to confirm. This is not a normal trading footprint. This is where actionable insights become critical for anyone involved in this name. You can monitor this data yourself. Official short interest data is published by FINRA and the exchanges twice a month, not daily. The SEC publishes FTD data, which you can look up by ticker. Another key metric to watch is the off-exchange short volume. For BURU, the off-exchange short volume ratio has been consistently high, often over 50%, 54.91% on November 13th. This means that more than half of the total shorting activity is happening in dark pools, away from the visible, lit exchanges. This can have the effect of suppressing the price without triggering market-wide buy-side circuit breakers. Recognizing this, investors can understand that the price they see on their screen is only part of the story, and significant selling pressure is occurring in non-public venues. The institutional ownership data confirms this is almost entirely a retail and short seller-driven stock. Total institutional ownership is a tiny 1.35%. Recent 13F filings from the last quarter show that major trading firms and banks, including Morgan Stanley, Virtue Financial, and Jane Street Group, have all completely liquidated their positions, reducing their holdings to zero. The only significant holders are Vanguard and Geode Capital, with 722,000 and 492,000 shares respectively, positions that are almost certainly passive index fund holdings, rather than active, bullish bets on the company. The smart money, by and large, has already left the building. This leaves Nuburu as a story of two warring expectations, primarily fought on social media forums and trading chats. On one side, you have the cautionary group, pointing to the dilution, the debt concerns such as a $4 million debt owed to Supply at Me Capital, and the going concern warning as proof the company is a sinking ship. On the other, you have the optimists, who believe the defense pivot is the real story. They argue that the blue laser technology is a genuine asset, and that one single decent-sized contract from the defense industry for its new drone or security ventures would completely re-rate a company with a market cap of only $32 million. They see the institutional exits and high short interest not as a warning, but as a setup for a massive squeeze if their thesis proves correct. So as we look to the future, the outlook is binary. There are two distinct possibilities. The first is that the defense pivot succeeds. The acquisitions of Techne and Orbit, combined with the Maddox drone partnership, actually secure a meaningful contract. This would provide a revenue stream, validate the new business model, and allow the company to raise its next round of funding on much better terms, squeezing the 17 million short shares. The second and more likely scenario, given the financials, is that the going concern warning was accurate. The cash from the $12 million offering is burned through trying to integrate these new companies. Revenue fails to materialize. The company is forced into a reverse stock split to regain price compliance, followed by even more dilution to pay the bills, ultimately wiping out current shareholders. The key catalyst to watch for is the next quarterly report. The market needs to see the cash balance. We need to know how much of that $12 million is left, what the cash burn rate is, and if these new defense acquisitions have contributed a single dollar of revenue. Comment below with your honest take. Is Nuburu's shift to defense a brilliant strategic move or a last-ditch effort to survive? In the end, the disconnect between expectation and reality for Nuburu is one of the most extreme on the market. The expectation is a simple, high-growth story about a unique technology. The reality is a corporate survival